Hello, my people. Welcome to another episode of the Let's Talk About Everything series. It's a new week, and I'm very excited for everything that's going to happen this week. The month has progressed really fast, and we have continued to chalk out these episodes. I have so much more in line for you guys, so keep it tight with me. Today, I have on the show one of the most experienced and distinguished marketing leaders from Africa. But today we're not talking about his marketing journey, which has traversed a lot of startups in Nigeria, established companies. He digitized a lot of the newspaper platforms in Nigeria and led a lot of global e-commerce companies to find that product market fit. But today we're talking about his own personal entrepreneurial journey. I bring to you Onyeka, Akumah.
Hi, fine.
Hello, Onyeka.
How are you doing, man?
Very well, thank you. Thank you so much for joining me today.
Thanks for having me.
Yeah, I've known Onyeka for over 12 years. It started out a bit scandalous when I wrote an article about him many years ago, but we became fast friends. He was my boss, my friend, and so many other things. Onyeka, tell us about your entrepreneurial journey. If you were to do it all over again, what would you do differently?
Wow, that's a very good question, Ifeanyi. The first thing I would say is I wouldn't change anything. I think the entire experience I've had building businesses and all the challenges I've faced building those businesses have shaped me into the man I am today. And so if I was going to change anything from my past, I wouldn't essentially be this person I am today, to which I'm grateful to God that I am where I am. The things I've learned, the things I've grown through, the things I've had to endure, the successes I've had, and the failures I've had, I think everything has shaped me. So going through my entrepreneurial journey, I think I'm grateful for all the experiences I've had, the people I've met, networks I've created, the businesses I've built, the jobs I've made and created, and I'm just going through life dealing with the different scope of what I've experienced to use it to continue to create value for people. So I think I would still say I'm going through life doing the same thing over and over again, taking my lessons from them and doing better the next time I try again.
Excellent. Now, today Onyeka is talking to us about the entrepreneur's guide to venture capitalists, accelerator programs, and raising funds. Now, Onyeka has tackled some of the biggest problems in Africa, from travel to agriculture and now to transportation. He's the CEO of Trips, a company that is in 5 countries in Africa, growing to more countries, and is even expanding to Canada. We got some insider tips today, but I'm not going to reveal it. Onyeka, talk to us a little bit about raising. Now, a lot of investors or a lot of entrepreneurs I meet always sometimes don't know the difference between an angel investor, a Series A, precede the seed, Series A. What's the difference between all of this, and at what level of dilution happens across all these different parts?
Okay, so the thing about raising capital or raising funding from investors is that it starts first with a relationship you build. It's a relationship game first before it becomes a numbers game. And many of the investors that are the best investors I've come to work with, I usually find myself in a position where there's an established relationship, either in the previous startup I did something in that they were excited about and loved the way I built that business, or I loved the way I worked with that business, and then they decide to want to invest in the future business that I create. These are relationships that I call relationship capital. They eventually turn out to become cash and become equity that goes on to fuel the growth of the businesses that I've had to work with. So what happens is, as I go into the new businesses, these investors then become angel investors. They are the first set of investors that follow on with family and friends that are able to raise capital from, or the founder's equity that is able to contribute. These angel investors are those early investors that put money into the business to try to grow the business from an idea into a seed that you can plant in the ground and create value for people from. And then the next level is then you've now turned your idea and you move it from paper into becoming a product that you have a couple of customers that are already paying for it, and people are grateful that you've created this valuable business. And so you've gradually started recruiting people, bringing people to the team. You've moved from a 0-man or 1-man team to a 10-man team. At that point in time, you have some traction, maybe 3 months traction that you're using to showcase the growth of the business. What then happens is you then, especially if it's a business that you know you will need venture funding down the line, that's something every entrepreneur must be clear about from the onset before you even start raising money. Are you building this business to sell? Basically, look at your exit. Are you building this business to sell? Are you building this business to go public? Are you building this business to create a personal empire? None of it is wrong. You just have to be clear which one you're doing so that you understand how you design who you will call as investors or partners that will join you in growing that business. If you're building a business to sell, and similar to what Rocket Internet will do, it's grow fast, break things, just put money into it to get as many customers as possible, and then find the value in that business that you can sell to a new person that wants to take it on and establish a well-structured business in the future. But in the early phase, it's all about putting money into marketing, getting customers, and then solving problems as they come, but running really fast. If you're building a business as your own empire, you want to make sure you take your time. The investors you will bring on are very patient investors. They will put in their money and they want to wait 15 15 years before they start making a decent return. And so you know who you're talking to at that point. You're building a business that's going to have an IPO or go public. It has that similar start to the one that goes really fast, but the difference is that you have your eyes set that you're going to take this public to get public investors to now invest on the stock exchange as well. So having said all of that, you've raised an angel round from a couple of VCs that were your friends or people that were excited about what you've done in the past or have within your network. The next stage is then you've started getting customers paying, you've built some traction. Ideally, what you see many startups do, many of the startups that I've built, is this is the point where you're looking to get into an accelerator program. Because in an accelerator program, it then takes you beyond your environment to have the right kind of network, the right kind of connection, the right kind of environment to try things, and then the right kind of exposure to other investors, to mentors, and people that have done this before, who will then create some value for you to grow your business. And so usually these startups stay between 3 to 6 months and they get into accelerator programs. Eventually get into those programs, they do a demo day that is the biggest showcase of that startup on the world stage, and then the media talks about it and writes about it, and you get more customers coming. Usually what happens after that is those startups go on to raise their seed round. But these days the categorization of seed round, pre-seed round, I think the walls are breaking, because what used to be a seed round, in fact what used to be a Series A round, they're raising $5 million in funding, it's now pre-seed. You see someone telling you that I'm doing the pre-seed round of $5 million, like, wow, are you sure you're doing the pre-seed round? But it's still looking back at the fundamentals of what these rounds are classified as. Your seed round then comes into play after maybe your demo day, or you've gotten some traction and a lot of people are paying attention to you. 1 or 2 strong media outlets have written about you, you've grown your customer base, your team strength has gone from maybe 10 to maybe 20 to 30, and so you raise a decent $1 million, $2 million seed round. And what you do with the seed round is you're now trying to find product market fit, where essentially you know that you've created a product that over time the customers are using it without so much customer acquisition cost going really high. You've been bringing it low, and these customers are coming back on a repeat basis, and they are using this software or this value on a daily basis or on a week, based on the timelines you've set for yourself or what you call what your KPIs are set out to be as traction. You see these repeat customers coming in, and they are growing and they are bringing in more customers, and you found maybe product market fit. It all happens around the seed stage. What then happens next is, as you've put things in place and you've tried things out and your seed stage is coming into form, you then start paying attention to, okay, how do I then grow this and then create a formidable business out of this? That is when most startups will then invest in their finances, invest in their structure. It's good to do that early, but I mean, it comes into play more once you've raised your seed round. You have a very strong financial model, you have a very strong business model, you have a very strong team of people who are supporting the idea. So it's moved from the founders to now who's your head of HR, who's your head of operations, who's your head of marketing. And this solid team then creates a strong base for an investor to look at this strong business and say, okay, this has product market fit, it has the right team behind it, and now maybe they can scale their operations into new markets. And so you raise your Series A round. Your Series A round will essentially come into play once you've been able to prove your product market fit is intact. You have a very solid financial model that investors can see and can predict that if they're putting in $1 into your business, this is what they will get in return in the future. You already have a clear market roadmap for how you're going to grow, and that essentially then gets that business to that Series A where they're able to then get very solid investors. And usually you find that the angel investors, many of them want to exit the business at Series A and Series B round, where the business has gone from a value of maybe $500,000 valuation, and it's now gone to, maybe it's done a seed round and it's raising at a $5 million to $10 million valuation, and you've now gone into your Series A round where you're raising maybe at a $15 to $20 million valuation. Those angel investors may want to cash it on some of the investment strategies. So you start looking at reducing, putting a fund to your cap table, where some investors make some returns, and then you're using the monies that you have, and a new board usually comes to play in your Series A. Some do it in their seed stage, they set up a board. The investors that usually invest in Series A want to have a board seat. You set up that board and put everybody into the place, and then you start growing the business from there. Ideally, your Series B round is when you're taking this business to new markets. So you're looking at getting into new markets with the funds you raise in your Series B round. What is there seeing happening with C, with corporate structure, D and E and F, and all the many other rounds that happen, is as this startup starts looking at getting public or starts looking at exits into another stronger business that wants to take it in and turn it into a product for themselves. That's what you see happen with those future plans. So I hope this provides some insight.
Thank you very much, Dr. Onyeka. Recently, Texas just announced you as one of its all-star global mentors, one of the first five out of Africa. Congratulations. Now, we're talking about Texas. Texas is an accelerator program that has accepted a lot of Nigerians, a lot of African startups, very similar to what YC is doing with African startups. I want you to talk to us a little bit about accelerator programs. What accelerator programs do for you, and how do we get into accelerator programs?
Okay, so yes, I'm very excited about the innovation and the award by Texas. It came with me mentoring over 60 startups through that program. And what I've seen, the benefits that I've seen Techstars or any accelerator program provide for me and my startups is, one, they give me a network of mentors that I can get access to get more knowledge than I know about the industry I'm in. Two, they give me a platform to showcase my business to the global stage. That demo day is usually a major media event where you have over 200 investors sitting in a room and over 50 media outlets paying attention to what you have to offer over a 5 minutes to 6 minutes period of you talking and holding that audience down. Three, they give you access to investors. Investors that you may potentially have not been able to reach out to on your own, and they'll pay attention to you. But now, through Techstars introduction, you're able to, or this accelerator introduction, you're able to get through to these investors, and they'll pay attention to you because there's a brand behind you giving you access to them. Four, the community. The relationships you create. I've seen many accelerator programs take on startups and take on founders who then create something out of that accelerator just by meeting in that accelerator program. And there are different kinds of accelerators, just to point out. There are those that are excited about bringing on founders and then nurturing those founders with different ideas on how to focus on problems. And then they take 2 or 3 founders and create a team out of them. An example is Antler, who does a brilliant job with this, with many founders that they bring into a 30-man class and then a 30-people class, and then they make these founders meet themselves and then create solutions for problems that they've identified in the world. There are also the accelerator programs like Y Combinator, like I mentioned, or Techstars, who have invested in a couple of startups. And then there are others that wait for startups to go through these accelerators and then provide them with added value, like Google Black Founders Fund, SOSV, or Orbit Startups. These guys wait for them to come out, and then they see that they've already launched and they have a program that's running. They provide additional funding and access and reduce the burden of having to do everything with cash.
Amazing. Okay, great.
I think these are some of the things that I've seen beneficial from these programs, and I'm very excited about their benefits.
Amazing. What is the highest amount of money that accelerators invest in startups?
It ranges. So you can have accelerator programs give you between 25,000 to 500,000. So it ranges between 25 and 500,000. The most accelerator programs sit on 120,000 as monies they invest in startups. But recently, Y Combinator increased theirs to 500,000. The terms are different. Yeah. Some will take 7%, some will take 10% of the company. Some will do their investments on a safe or a convertible note, to which the startup will go on and raise further funding to convert that into equity.
Excellent. You recently launched your mentorship program with Onyeka to mentor young startups. Congratulations, and thank you so much for that work that you're doing for African startups. Now, my question is a little bit around mentorship. What's your advice to new startups, first-time startups? What do they do? And then in terms of their approach to getting into accelerator programs, what would you advise? Okay, so first, speaking to general startups, right, and what do they do when they're launching a new startup, you've got to make sure you pay attention to your founding team. It's very crucial that you look at people that have similar core values. You look at people that you've had history with, people that you can tolerate their shenanigans, because that will come a lot of it, either from them or the pressure of the business itself. Yeah. And you can work together and create value from. I think it's one of the first things I would say. And then as soon as you identify a founder, put founder agreements in place so that you protect yourself, protect the other founder, and protect the business from any issues that may come. That's one. Two is start small, grow fast, learn from the mistakes you make, and then go big. Don't go big from the onset. Start small. And in starting small, you take on a problem. You're solving that problem for one customer. You see how you've created value for that customer. You solve it for the next customer, and then use that to then grow your team to solve for 10 customers to 100 customers to 1,000 customers. Even if you have the money to go for 1,000 customers, still start with 10. Because the problems you will face with 10 and the way you deal with those problems will help you know how you deal with problems at 50 and 100 before you get to 1,000. So start small, then fast, grow fast, and then start growing start going for the big tickets after that. Excellent. Advice to get into accelerators.
Then the advice to get into accelerators is, first thing is, you pay attention to when the accelerator programs are ending their previous accelerator programs. So when demo day is done, usually the MDs of these companies or these accelerator programs are looking for the next cohort within a month after demo day. That is when you should start paying attention to them and start looking for the applications open. Two, when the application opens, apply as quickly as possible. Why do I advise that? When you apply into an accelerator program, usually the first time you apply, a person may see your application and say, okay, I'm paying attention to this, they have some magic I'm excited about. But what excites most accelerator programs is they see your progress from your first day of applying. Now, if you apply late, they won't have the opportunity of seeing your progress. And usually these applications are open for between 6 weeks to 3 months. So you apply very early and then start giving updates about your progress. And that's 2. 3 is make sure you have a team. Because in fundraising, the CEO usually focuses on fundraising. And if you're the CEO and the sole founder leading the entire organization, when you start focusing on fundraising, who then is going to run the business? Usually accelerators pay more attention to teams of 2 or more so that they see a team that will allow one founder focus on fundraising, especially when you need to do that more, and another founder focus on growing the business. Final advice I'll give is, remember, it's a relationship game. Do your research around the founders, do your research around the accelerator you're applying to. Make sure you're applying to an accelerator that has an appetite for your own industry. Don't look at an accelerator that's focused on fintech and you're an architect and you're trying to get into fintech, except you have a fintech play. They won't pay attention to you. So do your research on them, and when you get into those meetings and those interviews, don't act cheeky, don't act clever. Just say your truth and be authentic. That is how you will be able to convince these people that you're doing something genuine, you're doing something that is worth them investing in. Remember, they are going to invest in you. If you were in their shoes, will you invest in yourself? Ask that question to yourself first before you start applying to those programs.
Amazing advice for new startups, even for growing startups. Now, Onyeka, you're about to enter the next decade of your life.
Yes.
What is your focus in this next decade?
So in the first 20 years of my life, it was my formation years. I look at it as 0 to 20. I was just learning the ropes, trying to discover myself, know what I was passionate about. I knew I love art, I knew I love to creating things with my hands and creating value for people. The next 20 years, the next 10 years of my life, 20 to 30, I spent that building other people's businesses. So this was my time in Ghana, Deloitte, Travel Better, and Junior and Kumga, where we both worked together. And I was devoted to building people's business like it was my own business. The next stage of my career was building my own businesses. And that was the last decade that I'm just wrapping up this year. And I built some businesses that I'm very proud of. I made many mistakes in some, but I built many that I'm so happy about. The real estate business has over 20,000 tenants that is providing accommodation service to. Transportation business has moved over close to 5 million people across the continent, and it's growing. The AgTech one has done its own bit. I've learned my lessons from there and seen how to do better, assuming I do something else in that sector. But just generally across these spheres, I've learned a lot around building businesses. My next decade is going to be devoted into connecting the monies or the funds that I see that startups need to do startups. I want to focus on how funds get to the right startups and founders. I want to focus on how funds pay attention to the real meat of the problems that are in Africa and make sure they're the ones that they are funded to create value for people on the continent. So this is where my next 10 years will be. I'll be doing more around storytelling. I'm doing more around telling stories from my own experiences, but also I'll be doing more in getting founders the right kind of funding they need, and connecting them to funding, connecting them to opportunities to open them up to doing more, but especially when they are solving real problems and not necessarily copycat solutions that they've picked from elsewhere and think it will work on the continent. So that is where I'm going to be devoting more of my time. I'll be teaching. I've already started teaching at Rome Business School. I started teaching at the Rome Business School, and I've started using my mentoring platform to teach. I've taught at the Lagos Business School. I've given some lectures there. I'm open to doing more of that through my platform or through the opportunities that allow me to do that, but more around how I connect funds to entrepreneurs who need this to solve new problems on the continent.
Amazing. Thank you very much, Onyeka, for joining. Thank you very much for sharing.
Thank you very much, Ifeanyi. Thanks for having me on this.
Of course. Thank you very much, guys. You listen to Onyeka. There are so many nuggets, whether you have a startup right now, whether you're going to build a startup. You can connect with me. You can connect with Onyeka. He has so we can connect to his mentorship program through his website, through his LinkedIn, or through his Instagram page. I look forward to seeing you guys in tomorrow's episode.